All right, all right, all right. Good evening, ladies and gentlemen. What are we going to talk about, man? The markets are actually on fire pre-market thanks to a bunch of stuff Trump's tweeting, whether it becomes a deal with China over the weekend. We're going to talk about the pharmaceutical play here that might be tanking thanks to this massive cut toward drugs. I'm not sure what the take is on that. We'll talk about the stocks that are pumping me to highs here because, I mean, we really got to get into a lot. My portfolio should cross hopefully $400,000 tomorrow. It's crazy how fast we got to this point, considering the insane drops that we've experienced, because pre-market is really showing some green. And I'm literally like, not even a 0.5 of a percentage point to basically being at that 400K mark, which I haven't actually been too aggressive over the last couple of weeks because I've been rebuilding my portfolio back. But more importantly, what I want to do is something that helps you. Before we talk about the stocks, the news, everything going on here, I really just wanted to roll back and just kind of talk to you guys about, plan building and orienting yourself in a way that trajects you toward that $1 million mark or beyond. Because I've been doing a lot of one-on-ones, which I thoroughly enjoy talking to people at all spectrums of their financial independence journeys. They all have different horizons and times. But I always keep asking myself, like, is the dream still a reality? Because in Canada specifically, and I'm sure in the US, Canada is a very expensive place to live. And a lot of people that come here keep telling me they don't want to live here. The grind is way too hard. If they come here on student visas, work visas, whatever, they're just, living in closets, fighting to just keep a roof over their head while they try and educate themselves. I think if you have a roof over your head or whatever, like, it's a little easier if you're living with your parents. It was something that I experienced during the non-expensive Canadian era. I feel like this expensive era has only really come upon us in the last, I'm going to say 7 years or so, especially since after the pandemic. But nonetheless, I still kind of, again, like, I always reduce it down to, if I had to start over, what would I do? And I've told you guys this time and time again, I would just go to Alberta, get into the trades, bank as much money as I can, living in a bedroom with a bunch of friends or with parents. I mean, I have nothing against living with parents if you can pull it off, or living in a small room where you're out doing work all the time. Obviously, if you work from home, it'd be a different lifestyle, but I would hit the trades up every day of the week right now. But they're still saying that the average median after-tax income in Canada is about 68,400, and that was as of like 2021, and it has been going up. So I'm hoping Canadians out there are making somewhere around 70K after tax. It's pretty good. I feel like this is the median, or these numbers are being brought up a little bit by the people that are probably making a fortune, because something tells me there's still a lot of people making less than this. Because I think to make 68K, you got to bring in what, like, probably 80 or 90 at least. We'll talk about the taxes in a moment, but let's just use this as a base idea, because I don't think this is an unreasonable amount of money to make. I don't think it's unreal to make a 70 or 80K salary in Canada, especially in the trades and stuff like that. So if we take, like, let's just use whatever Google's telling us here, and we take 68,400, we divide it by 2, and you're able to save 50% of your income. And I want to show you, and this probably is unreasonable for a lot of people, but we'll even reduce it down a bit farther than that, because that would be like $34,000. And I just want to show you, like, if you can take half of your income and put it away, I want to show you how quickly you can get to $1 million. And I'm not saying it's going to happen overnight by any metric, but let's even fundamentally reduce it down to 2,000 a month. 2,000 a month to some people is probably a lot of money. This was the mindset that I always had, was if I can just put 2,000 away a month, in how far can I be in 15 years if we get market average returns, right? In the S&P 500, presuming we continue to get this accelerated rate of like 12% over the last decade, and since inception, 13.86%, which is crazy. But let's just use the 10-year average of about 12%. If we can just consistently get that 12%, at 2,000 a month over 15 years, you're a millionaire, right? And I like stressing this because this compound calculator is probably one of the most valued tools anybody can use for like financial planning, because you just got to ask yourself, like, what rate of return do you want, excluding dividends and everything? You just want total returns. What's going to get me to this specific goal? Is it $1 million? Do I want to retire in 20 years, 40 years? Do I want to retire quicker than that? But even if you don't want to retire quicker than that, I always come back to that like Starbucks coffee example, because like, if a coffee is going to cost you $5 a day and you're that crazy to pay that amount, and you do that every day, 365 days a year, you're talking about $1,825. If you invested $5 a day over your entire investing career from 20 to 65, that's going to give you 45-year run rate at a 12%. If we're lucky enough to continue to get that, over the inception, which has been much better than that. Well, I mean, the S&P has been pretty generous, but still, that's $2.7 million, right? So it's like, even just $5 a day could change your life in retirement. And this is just the value of investing, right? And I think people make it more complicated than it has to be. But if you want to fast track that independence, I mean, this tool should definitely help get you there, I think. So I don't know. I like showing this because I don't want people to think that the dream is dead. And then things get a little bit more technical because this is what I was talking to with some people that are kind of more closer to retirement, having some of those one-on-ones over the week. And it was just trying to figure out like tax implications and to show you why another one of those valued things about investing is just how little tax you pay. Now, obviously, I hope you're not that much of a noob, but you understand maxing out your TFSA, RSP, and the tax deductions that come with that, and now luckily the FHSA. But what I think is more prudent is just understanding the different levels of taxation, because if you make 100K a year in Ontario and Canada, you're going to pay about $26,000 in taxes. Now, let me just show you the comparable difference. If you were to make a capital gain of, say, 100,000 realized on June. I think this has to do with we'll just do with the is this on realized before June. Let's just say it's after, because it's the new tax implication that I don't think exists anyways. But let's just say you're going to make 100,000 in capital gains. You're only going to pay $7,000. That is a drastic difference than what you pay as from a salaried position at a job. Unless you get eligible dividends, 100,000 in eligible dividends, you're going to pay even less, only 4,000. And if you make 50K in eligible dividends, you're going to pay almost zero tax, $600. So it's crazy, right? Because it doesn't matter what you look at, even if they're ineligible dividends and you make $50,000, you're going to pay some tax, but you're only paying $2,000. I mean, it's crazy how little tax you pay on investments here in Canada. 14,000 if you're going to make 100,000 in ineligible dividends. I'm always floored by how little rich people have to pay in taxes here. And like literally the working class subsidizes like everybody, even the rich people, because rich people just don't pay taxes. So it's really important to be in this investor class. And I've heard a lot of people talk about like this future that we're heading toward, where my friends and people that have to live in this world, it's getting a lot more expensive, complain endlessly about how housing's unaffordable and it's all the government's fault, and they're always pointing fingers at other things. And some guy made a good point. That's just because they're not part of the investor class. They're not part of this growing system, this economy. And it's so prevalent and important that everybody becomes a part of this, because you stop being so jaded and you're like, oh wow, I can actually make real money off this stuff if I just saved a little bit over incremental amounts of time. 5, 10, 15 years can be life-changing and fast-tracking. But that's my little, public service announcement for the beginning of this stream nonetheless. So let's talk about what's moving the market right now, because right now it's the U.S. claims substantial progress in tariff talks with China as Geneva summits kind of wrap up. And we don't actually have a China deal yet in the United States, but this is what's really helping propel the market. But in the absolute flip side of fascination to me is that this tweet that came out, and I think every U.S. citizen, regardless about how you feel about the healthcare system, I'm kind of on the Bernie Sanders side of things, that healthcare should be a universal right. It shouldn't, be class system based. Like, it should be healthcare at any income class, like it is in Canada and many other places out there. But basically, Trump's saying that prescription drugs and pharmaceutical prices will be reduced almost immediately by 30 to 80%. They will rise throughout the world in order to equalize, and for the first time in many years, bring fairness to America. Now, I honestly don't think America is like the drug innovators they used to be either. I mean, there's a lot of countries right now that are claiming some pretty incredible things toward different cancer cures and genomic editing. So I don't know how this is going to work, because drugs are like ungodly expensive in the United States. And I don't know how you get other countries to subsidize those expensive prices, how they even get that expensive in the first place. It's complicated. It's confusing. It's a really, really odd thing. And obviously this is going to detriment the healthcare sector. And it's going to be neat to see how much, healthcare stocks drop, because, like the COVID vaccine and many other things, I mean, those pharmaceutical companies got awfully print off drugs. So 30 to 80% drop, and it's going to be quite wild. So basically, he's claiming to bring fairness to America. I will be instituting the most favored nation policy, whereby the United States will pay the same price as nations that pay the lowest price anywhere in the world. Our country will finally be treated fairly. Our citizens' healthcare costs will be reduced by numbers never even thought. I'd be curious to see in countries where, the government subsidizes the healthcare, what we would pay for the same drugs and comparable to what you guys pay in the United States, like even insulin and like very basic drugs. Be very curious, because I know a lot of people were complaining about what are they, the shots you get for when you have like allergic reactions, just costing a god awful arm and a leg. in the United States. I don't know if you live in the US, I'd love to hear about it. But all of this still is just boiling down to this tariff talk, and in between Trump bitching about the Federal Reserve and how unfairly they're treated, and the fake news media. If you kind of get through all the bullshit, it seems like the tariffs are starting to get walked back to some extent. Trade deals are coming into place. People are realizing there's a lot of fluff just to kind of build out, deals, or at least so we're being told, favorable deals. God knows what the damage is because GDP is going down. But overall, company earnings were good. The tariff talks are starting to get alleviated. So all of this is pointing back toward a fairly bullish market, depending on what side you're playing in. And I want to discuss stocks specifically because the stocks that I've been arguing with people immensely about over the weekend, the ones that I'm trying to make some banger bucks on here, we'll start with Google, but some of you are asking me, would you recommend the S&P 500 leveraged ETFs, SPXU, 2X? I don't mess around with leverage that much. I mean, if you look at like the triple leverage Qs, would have been the best bet over the last decade, but I really am much more of a very simplified investor. I think people, you basically, when you're buying these leverage ETFs, you're really hoping, and it seems to be true more than it is not, that you need a lot of up days in the market than negative days. But when you get those severe, 2X is better than the 3X, because as we've seen with the QQQ ETF, I mean, when you get these massive down days, it wipes out a lot of those returns. But even still, if we get more up than down overall, you should be all right with a 2X, because at least with a 3X, you don't have the risk of a 30, I think what you need a 33% drop in one day to go to complete zero on one of those ETFs, which has never happened in history, but it's not that it can't happen either. A lot of people like the 2X, so I don't think there's anything against it. If it's the risk that you want to take on with the percentage of your portfolio, by all means. I am a very simple person that just likes to try and itch out my extra gains from the individual stocks that I play while letting the ETFs carry me at this point. And Google being one of those, I think, is the most interesting discussion today, because it's just a matter of, is search dying? And I was having this massive debate with a bunch of friends and people, as Google's trading at this unbelievable valuation right now that it's either the beginning of a dying company or an over exaggeration into how long and what the shift from search to these kind of AI bots actually look like over time. And what really kind of confused me here is I just want to listen to, because I've been listening to like Dumb Money, their podcast, obviously these guys, the All In podcast. And I just want to play a little clip here because I think it's such a fascinating topic. And then I just want to show you what Google is saying about their search.
Than even search itself. Freebird, your thoughts?
Well, let me ask all three of you a question, which is, since ChatGPT's come out and Gemini and other tools like it, do you find that you're doing generally more stuff or less stuff?
I find that I am using search a lot less.
But the aggregate, is your aggregate like usage of the internet to do things for yourself, for work, kind of, are you getting more?
Yeah, I've learned how to ask things that I've always wanted to know but didn't even know were possible.
Right.
But all of that to me goes to OpenAI and to X. I use Grok.
Right. That's fine. But I'm just saying, like if you were to, because I'm what I'm trying to do is paint the picture of where the denominator of quote search queries is going. Because if search queries is no longer
that's the wrong way to think about this.
No, right. I like your framing. I'm doing 5 times as many queries, and I would say they're spread across a number of different platforms, because instead of asking humans to do work, I'm now doing it myself. You used to ask a human, hey, can you do this research for me? And they would come back to it. Right. You would hire somebody to use a consultant. Now I'm doing it myself. So you're onto something that the total volume, the total pie could be 5, 10 times bigger I think, like, per person.
Yeah, if the old paradigm is like measuring search queries and quote market share as a function of search queries, I don't know if I care about having 99% of that, or if I'm actually better off having 80% of something that's now 3 times bigger.
Yes.
Where there's so much more usage.
Imagine you lose 99% of one bucket, but you're only getting 10 or 20% of the new bucket.
That's the bad scenario. That's exactly right.
This is like the fascinating discussion, because like Google released this statement and everyone just keeps telling me why they're selling Google off because of the risk to search. And if they it's 50% of their revenue. So we're kind of playing this chicken game where the rest of their businesses catch up and start, becoming a much more massed version and maybe become like, I think if we get to 75% of other income for Google and 25% search, people would be a lot less concerned, because they think this is happening overnight. And the only reason that I'm buying Google back now is because ChatGPT has been out for a while. All of these like language models have been out for a while now, and Google released this statement that kind of really falls in line with what they were saying, which is we continue to see overall query growth in search. That includes an increase in total queries coming from Apple's devices and platforms. More generally, as we enhance search with new features, people are seeing Google search is more useful for more of their queries, and they're accessing it for new things in a new way. So I think what they're saying is correct here, right? Like, I feel like people's use of the internet is expanding, and they're just doing more queries across more platforms. And, even if Google loses some of that bucket, as we can tell right now, there's still a dominant feature, and search is still growing revenue for them, regardless of if they're losing kind of search share. Because even if you're losing search share, but the entire bucket is expanding dramatically because people are just searching 10 times more than they used to, is it really that big of a deal? And that's the game that we're playing with Google right now, as I make a ridiculously massive bet on it. And I hope that it pans out here, because I'm sitting here looking at it and people had me a bit concerned, but the more I go through my due diligence and homework with this company, I'm just like, I just don't see it dying tomorrow. So like, even if we wait and it takes 5 or 10 years and it's a slow bleed off of losing market share, their other businesses will far surpass and make up for that value, hopefully in the meantime. Right. So, and then I'm looking at the same thing, and we'll talk about some of these Canadian stocks too in a minute. But Meta, I think is kind of getting a pass here. A lot of people were crapping on Meta and Facebook, thinking this company was just old people news and it was done and over with. But I think Meta's got the advantage Google doesn't, and same with Microsoft. Because they can start taking search volume share, and it's a whole new part of their business, and their current businesses aren't exactly being that disrupted. I don't think anyone's really disrupting Facebook or Instagram or WhatsApp or anything like that anytime soon. So, I mean, they're still seeing growth in Facebook, which is super fascinating. I quit all Meta products. Really, I'm still using their VR. Like, was just playing VR, like not even a few hours ago. And I use Facebook. Me and my buddies chat on Facebook. And if you've never used Marketplace, I don't know what you're like. If you sell anything or buy anything, man, I mean, Marketplace is where it's at. eBay's done. eBay can't stand a chance. Kijiji's trash in comparison. Marketplace is absolutely amazing. Meta's got a lot of moats. And WhatsApp, you never use WhatsApp. It's like the most used like text messaging platform in the world, and they don't even monetize it. You know how many WhatsApp groups I'm in? My whole, like the company I work for, like they all work through WhatsApp. Like all my chat groups that I use are through WhatsApp. I love WhatsApp. I think it works fine. It's great when you're traveling too, because you can just connect to internet and you don't have to use the stupid Apple SMS thing. You can literally just use WhatsApp. It's a great tool. But yeah, nonetheless, I picked Meta up at some good prices. The wife has the majority of the stake, but I did manage to pick some up at 545, which wasn't bad. It felt bad because when I bought it back here at 545, it dropped precipitously. Like it went down like another 10 or 15%. But now I'm up on it because, I held it, which was great. But that's just because the wife saw like a 30% drop in the position. Meta was our largest position, and then it dropped like 34%. So all of a sudden, the position sizing in our total portfolios wasn't that material compared to like Take-Two Interactive and Google. So I was like, you know what? Never hurts to buy a little bit more if we feel like it's underweighted. And speaking of Take-Two too, I was really impressed because I still like the only reason that I'm holding on to this stock still is just because of the records that it just broke and the amount of videos I'm now seeing on the second trailer that came out. I mean, this is what I don't understand, why nobody in the finance world wants to talk about video games. I'm just saying, man, the trailer 2 broke records, 475 million views in 24 hours. And people are still telling me they're not going to sell 50 to 100 million copies in the first week or month this game gets released. And I think they're disgustingly wrong. And these numbers just show it. So we'll see if the stock picks up into the value range before the game even comes out. But then we don't even know about in-game purchases either. I mean, there's so much going on here that I got to hold on to it for a little while. But yeah, I mean, let's get into some of your Q&As here, because a lot of you have been talking about some of the banks. And I think it's good to comment on the Canadian markets here too, because Canadian markets have been on fire, baby. We've been outpacing the US for once. It's an odd world when Canada's outpacing, when Canada was supposed to be in the toilet. Not that we aren't in the toilet. I mean, our real estate in these major cities are having some problems right now for sure. I think we're seeing the biggest correction and volume slowdown that we've seen in Canadian real estate in major metropolis cities like Vancouver, Toronto, condos piling up. But yeah, we're seeing a recovery. I think we're finally seeing the bottoms in the, and I mentioned this before, and I only sold this to buy the S&P, which seemed more favorable and still seems to be at the rate it's returning. But I've told you guys that I'm pretty sure TELUS and many of these telecom giants have finally bottomed, and they've been great buying opportunities. Mainly TELUS. Rogers second, Bell third. But if you bought them as the basket, they're starting to do okay. Especially TELUS. I'm shocked at how good the earnings were. They increased the dividend. Their payout ratio is nominalizing. Interest rates are coming down, which they stated is one of the main reasons that they've been, seeing a recovery. And like I said, I told you guys that was what was going to happen. Here we are, baby. One of the most stable industries. The only thing is there's no real growth ahead of them right now. So like I said, we're going to see this initial bump, I think, in recovery over the coming quarters. I think that trend will continue. I think we could nominalize back out maybe to 25. I don't know how fast we can get back to 30, but I don't think a $25 price is unreasonable. And if you locked in that 8% yield, just imagine you're getting a full rate of return from the dividend. It's probably not going anywhere. And if this stock bounces back up to 25, you're going to get some capital gains out of it. You'll see probably an overall greater return from the company. But in the same, discussion, once that recovery kind of comes into play, you're buying a company here that I would not be buying for growth at this point. Like after that initial bump and we get out of the gutter here, you're just going to hold this as an income stock. I don't think you're going to see like a massive amount of growth like you could see at a Google or some of these other companies. But as a long-term hold, I don't think they're terrible. What do you think about UNH? Dropped considerably. So I've talked about this before. Like you got to do your due diligence and start understanding like why companies are dropping and what the future outlook looks like. And I've talked about this with United Health. And I said, you got to look at two things. And I don't understand healthcare at all. So I'm not going to touch this with a 10-foot pole. I understand Google search, YouTube. I feel like it's more in the grounds of understanding. You don't buy shit you don't understand. United Health has a few problems. First thing they said is that they're competing with other insurance companies right now that are cheaper and newer. And on top of that, not only do they have, competition that's coming into play that hasn't ever really been around before, you have to deal with a CEO that was assassinated, and the conversation around Luigi still goes on. You really gotta understand, like the man piloting the ship. Imagine if Elon Musk got assassinated. I'm just saying, like, you got to understand this ship is on a new course. The branding of this company is on a new course. If you are in the United States and you need healthcare, is United Health the number one healthcare company on your mind? Or you're going to say, man, after that CEO got whacked and this whole movement behind Luigi, oh man, the fact that they like deny 30+% of claims, man, there's got to be a better healthcare company out. Like, I don't understand why people get so giddy about these companies. Like, do you not see that as like a meteoric shift? Like our friggin' like tectonic plate just shifted and caused a fucking tsunami. I mean, like, you got to ask yourself, do you think that, you might know more than I do. Like, obviously I'm hypercritical because I think it's just complete trash. And I wouldn't buy into it for those reasons. But maybe you know something that I don't. Maybe you work for the company. Maybe things are fine. Maybe their revenues and everything are a lot more stable long-term than I'm predicting they are. Maybe, Trump mixing up the entire healthcare space isn't going to cause any damage. Like, I don't know. Like, I just, I don't know. Maybe you do. But yeah, I wouldn't touch this with a 10-foot pole. I mean, it's the same problem I have with Pfizer, right? Like, some of these healthcare companies, they look cheap, but they're very hard to wrap your head around if you don't understand their pipelines. I think Johnson & Johnson, like, when I look at each sector, there's always a company that like is an exemplifier of like what you want in performance. And I talk about this with Canadian REITs. It's probably like Canadian Apartment Properties in the healthcare space. I think it's Johnson & Johnson, because Johnson & Johnson is just the most diversified healthcare company. So they're not like relying on any one specific basket to like carry them. And if they come into lawsuits and stuff, like, they're very well capitalized. They trade at a favorable valuation. The dividend is within reason. The dividend growth rate is good. It's just your average company, but that's kind of what you want. United Health probably was that for the healthcare space. But yeah, I think I can understand Johnson & Johnson better than I could probably understand United Health. Thank you so much for the perspective. Again, I'm just a financial clown on the internet. Don't take this as financial advice by any metric, but, take it as a learning curve tool. And, if you find something that you say, hey, Kyle, you're wrong about this, then take the stab. I'm arguing with people today. I think they're wrong about Google. I could be wrong, obviously, and I could get, it's going to cost me money if I'm wrong. It's costing me money now, but we'll see. We'll see if holding long works out. What do you think about Hydro One? Hydro One is it is probably my favorite utility in the in Canada. I was going to say the United States, in Ontario specifically, because it's a very localized, it's mostly transmission lines, which I like. because it's the one that's just distributing the hydro. So regardless, to think if you're going to use something like Elon Musk's Powerwall, or you're going to get into your own like energy generation system, we have laws in these provinces that basically like you have to hook that up to a public power line. You cannot produce your own power on your property. And if you are, you're doing it illegally. Not that you shouldn't. I think it's fine to generate your own power. I mean, most people use generators for emergencies and other things, but when you're actually building like massive power generation on your property, it's supposed to be plugged into, the actual like utility system. And then you get usually discounts or paid out or whatever based on the input that you're putting into the system. But I love the transmission lines because Hydro One basically owns Ontario, and Ontario is going through a very big build out right now. I mean, obviously construction is going to be a big deal, building housing. A lot of housing going up right now, a lot of new condos, a lot of new transmission lines. So they have a steady stream of growth, and they're in a much more less volatile industry. I mean, this is one of these stocks where it trades at a bit of a premium, but it's nice when it dips, and we haven't seen a real dip in a while. So, if it drops by like 10%, I would buy it. Anytime it dips, really cost average into it if you like it. But it's my favorite utility. I don't own it right now. I debate on buying it. I should buy it. I keep saying I will. It's the same with like Waste Connections. You can buy Waste Connections on the Canadian ticker, which is great. I think it's TSC, isn't it? TSC. Yeah, I mean, you can buy it on the Canadian markets. And this is another one of those stocks that I kind of make comparable to like Hydro One. It's like they're never going to trade cheap, but they're never going to crash. Like they might go down with a market drop, but not materially. Like they're always going to have way lower volatility. And I just love them because they're boring as hell. I mean, we're talking about Waste Connections, literally a garbage company. And with the onslaught of what can happen with recycling, and considering these companies have to deal with the recycling, and we can start actually turning, plastics into profitable fuels, what we're seeing in Pure Cycle and Enduro Clean Tech. I mean, there still could be some huge growth vectors for these companies in new ways. But yeah, I like these companies. I think the more boring it is and the simpler it is and the less volatility it's going to have and the bigger moat it has. And, when you can find those upsides with them as well that can justify some future value, it's always great. MindMed is still the best healthcare company. We actually, believe it or not, we still hold MindMed shares. We were looking at my wife's accounts the other day, and she has we're mainly trying to after we purchased this condo, we've been trying to rebuild back our tax advantage accounts, and we still have like RSP contribution room and stuff. So we never looked at our regular managed accounts, like when we had maxed out our tax advantage accounts before, using that money. And like she had money in this account, and we're like, the fuck, like you have money in this account? Like we should put this in your TFSA. And we open it up and we're like, oh, you own MindMed. Like you're still holding a piece of MindMed in your regular brokerage account. I'm like, that's hilarious. Yeah, this is always going to be one of those gems, those unicorns that I was lucky enough to catch. Never caught Palantir, NVIDIA. I wasn't smart enough for that, but somehow, in 2021, you could have threw money at a dart. You could have threw a dart at a money board is what it would have felt like in 2021. You could have bought crypto shit coins and have made a fortune. And this one just had that lucky edge. I think with Kevin O'Leary pumping it up, it took it to the moon. I think in my entire history of investing, I think I've caught 3 unicorns when you get 1,000% gain. MindMed was one of them, Canopy Growth Corp, and I think Tesla. But man, they're hard because you got to have the balls to hold through to 1,000% gain. And if I sold this, if I didn't sell it, I mean, we'd have lost out an insane amount. I don't know why the chart's not coming up on Yahoo Finance. But either way, yeah, the stock's got a long way to recover. But yeah, what a fun story. Thoughts on Canadian banks by chance? Got to collect them all, man. Canadian banks. It's the only reason that I buy VDY. A lot of people think I buy VDY for diversification, and they'd be completely wrong. This is my one-stop shop Canadian bank ETF because, like, you can buy if you want, like, sector-specific. HBNK is great. This is the only other ETF I would buy if you want bank exposure. But VDY is literally a bank ETF, in my opinion. It's the only reason I really buy it because, you got to collect all the banks. They're just incredibly the best performing, financial institutions globally. So I get 13% Royal Bank. Like this isn't an ETF where I'd make it 50% of my portfolio just because it is that concentrated. I mean, you put 100 grand on this ETF, 14,000 is just sitting in Royal Bank, Toronto Dominion Bank, Bank of Montreal, Bank of Nova Scotia. They're all in here, right? And then you get the other stocks because I do like Canadian Natural Resources. I do like Enbridge. These are stocks that I would own individually if I was buying Canadian stocks. So it's just great that they're all market cap weighted. They're all top holdings. Like these top holdings make up like well over 50% of this portfolio. Like it's great. It's awesome. Like, how do you go wrong? But the problem right now, I think, with Canadian banks is they're a bit pricey. I mean, TD started to recover. We need some good earnings because this is the highest premium that these banks have ever traded at, which is kind of interesting. Like, if we use like Royal Bank, the biggest bank, as an example, and we just say like go on to revenue and macro trends, let's just take a quick look. I'm pretty sure right now is one of the highest price ratios we've ever seen. Yeah, I mean, we're trading at like 13, and you might think that's not like that high. 13 doesn't seem high, but it is a relative, considering earnings growth hasn't like gone bananas or anything. Like, there's a really good growth period in 2018, but we're just starting to recover from some of the drop-offs here from the interest rate cycle and maybe some of the hits to the economy or whatever. Considering they were putting like massive loan loss provisions aside, but we could be going into a no growth phase too if loan loss provisions level off. I mean, it's a catch-22. Maybe we're not trading that expensive if loan loss provisions start to alleviate. We won't really know. I mean, it's another interest rate recovery play, as I call it, but there's a double-edged sword because they can't make as much interest on the cash they have, which is what's been benefiting companies like Manulife so much. Because that's my other fear right now, is that like if you're heavy into the insurer players, you should be cautious, because these companies were able to print. Let me just look this up real quick. How is Manulife doing? Like, these stocks did nothing from like a capital gain perspective in like a decade. I mean, they really, from 2014 till about 2023, they didn't really go up that much, but they paid a great yield and they increased the dividend really well. But now they're like exploding, but that is purely driven by interest rates. And now interest rates are back down. So, there's just no way that cash flow is going to sustain on the capital they're sitting on. So just be aware of that. But yeah, I mean, buy the banks. I mean, if you're investing in Canada, the only real thing you need to own is the banks. Otherwise, everything else is just secondary. The banks have been like the real returning factor. And I can tell you that for a fact, because I mean, look at like VCE as an example. Like, VCE has Shopify and Constellation and Canadian National Railway and all those beautiful stocks, whereas VDY doesn't. But if you want to just see like where most of those returns have come from, like look at the last 5 years. VDY has actually been like, did I lose the ticker there? Oh man, what just happened? One sec. Let me just make sure I don't lose the ticker. I was like, what one's the colored one? So Canadian High Dividend Yield ETF is the first one, and then VCE is the second one. So VCE is the yellow line, and we can see that actually VDY was outperforming VCE for the longest time over the last 5 years. And even when you zoom all the way out, like the problem is the chart goes a little farther back for VCE, but for the most part, like if you put these lined up exactly and you include the extra dividends that you get off VDY and the dividend increases because they've compounded faster in VDY, you start understanding that most of the real returns in the Canadian economy have purely come from the bank and the energy sector. So that's why I don't mind not owning a broader Canadian ETF. I'd rather just get the dividends compounding better and an immediate cash flow at a monthly payout. You do pay a bit of a higher yield or higher management fee, but I think it's totally worth it. But nonetheless, what else are you guys talking about down here? You want to talk about BAM, another company, thoughts on the bank, saying BAM had a great dip, was buying as much as I could last 2 months. Yeah, people are saying that's the Carney play because he was like on their like board of directors or whatever. They've recovered quite nicely, actually. They're up 27%. Really, holy shit. Yeah, congrats if you bought the dip there. Yeah, this is another one of those companies that I never really bought into, but I imagine it's like the Berkshire Hathaway of Canada, because it really is just like an asset management company. And I mean, I've looked into them and they're very hard to kind of wrap your head around. They're like an alternative asset manager, and they own so much shit. They own some premium real estate, though. I will tell you, man, if you get bored, go look at the real estate this company owns. It's kind of disgusting. All over the world, too, like some of the most premier properties and like major landmarks, which came as a bit of a surprise to me. But congrats. Yeah, this is a great growth stock in Canada, pays a good yield. I mean, this is the U.S. ticker. Let's look at the Canadian ticker real quick. It's TSC, I think. Yeah, TSC. Yeah, I mean, this one, isn't there another one? BAM is like how many Brookfield asset? Because I think there's another one too. Isn't there like a bunch of companies that are related to Brookfield? Either way, great stock to own. Don't have anything bad to say about it. Other than, huge assets, crazy stuff. What are the Canadian banks rallying in the middle of a tariff war? So why are the U.S. stocks rallying in the middle of a tariff war? Why is Tesla rallying? I mean, who the hell really knows? I can't play that game of understanding. I just keep buying regardless. I'm more bearish, to be honest. I've always been a bit more bearish because I can't imagine, like, I don't know. I just have a hard time believing with how much GDP is getting hit. Small businesses are probably getting devastated. right now. I mean, I don't know how the markets are going up, but like I said, I don't really care. I'll buy regardless. Well, not as much now. Like when they're going down, it's fun to buy. When they're going up, I'm kind of getting bored again. I'm like, fuck, the good opportunities are gone. The good opportunities are gone, except for maybe Pure Cycle and Enduro, but they got some work to do ahead of them. Tesla ripping lately again for no reason. Well, they're ripping because things are evening out. Tariff wars evening out. They were saying that they were heavily affected by tariffs, but when you have absolutely no margins, everything affects your business. So, Tesla should be trading at like $100. Will we get there one day? I believe so. Here's a good question to ask you guys. Do you think that companies can hold hype for that long, or if it's just a bubble? Because in all reality, if you are a fundamental investor, you have to believe Tesla is a full-blown bubble. There's just no way you can't not believe that. It literally is just deteriorating, and the stock continues to go up, all on the promise of a product that doesn't exist. Like, honestly, I could, if you gave me $1 trillion valuation and then I just dilute you by 10%, I take $100 billion, I promise you, I'll build you the best fucking robots you've ever seen. That's how Tesla operates. Just give me $1 trillion valuation, guys. I will figure it out. I promise. Like, I will hire the best engineers. I will pay them more than Elon can pay them. I will steal all of them. You give me $100 billion, I will make it worth their fucking while. I will get them excited about the future, guys. I will. I mean, that's how this company operates. It's how a lot of companies operate today. Companies like Palantir, like there's so much promise on a future that doesn't exist. Now, I'm very bullish for that future, but you have to recognize that was what the dot-com bubble was. The internet was the biggest deal that ever happened. The problem is it took 10 or 15 years for that reality to catch up. And in the meantime, like, are you going to keep that hype? Can you keep that momentum? Because in my opinion, I really thought we were by the end of it now, and Tesla would have came down to still a premium. I mean, it deserves value, but my God, $1 trillion value on a company like this just seems ridiculous. Their margins, I think, are lower than GM's. They make less profit and revenue than GM. And GM is even doing power walls. Everyone's going to be doing power walls. Tesla has the best-selling vehicle of all time, the Model Y. It's the #1 selling EV. Who gives a fuck when you have the competitors like BYD that are now the #1 selling EV company? I don't care that you sell the best-selling EV. It's regardless if you're not selling it as, like, if all your vehicle lineups can't even match BYD. Like, you're failing at your core business. Not failing. I think failing might be a harsh thing to say, but still, you're losing dramatic market share because of your political bullshit. You think BYD is propaganda? I don't know. I don't believe that. I think BYD is much better at building products. And everyone that's reviewed their cars says they're incredible. They look incredible. I would love to buy one. The cheapest one they make, I think, is like 15,000 CAD. Like, they actually have a lineup of affordable vehicles that are like for normal people. The cheapest like Tesla you can buy right now is still like, what, 70,000 Canadian dollars, in Canada. I think it's ridiculous. And then if you want self-driving on a base Model 3, it's like 80 grand. Like, how the fuck are you going to sell any cars when you're charging 80 grand if I just want base self-driving at like the cheapest model you offer? It's ridiculous. Like, BYD is selling like cars you can buy for 23,000 CAD that don't suck. Like, if you lived in a city, they are incredibly affordable, and our stupid government, and they're all abiding like, we got to protect our auto industry in Canada. We got to protect our auto industry in the US. But, oh, guys, climate change matters a lot. We really cannot have climate change. So we are the most inefficient country at making fucking electric vehicles. Yet we're not going to let the country that is the most efficient, that is fast tracking, this green energy future, because we don't want to kill our industry. So we're going to harm literally like our primary mission of carbon reduction. Well, we had carbon tax charging you for the gas you were using, but we're not going to let the carbon efficient vehicles come over. That's government for you right there. But I don't care if you hate BYD or not. I don't care about their business. I've never really bought into it, but like, you have to recognize that they're not bullshitting their numbers, and you look at their lineup of vehicles, they're doing something. Like, they're definitely doing something. Yeah, Warren Buffett, I mean, they made a shit ton of money on BYD. I think that was like Charlie Munger's last real like hurrah to Berkshire. But I think he owned it through I don't even think it was in Berkshire, was it? I'm pretty sure it was in the Wall Street Journal or whatever, that other company that he was on the board of directors. I don't know how they owned it, but I bought a few shares of Aduro when it was 550 CAD. It gained 13% last week. Are you still a strong believer that it could be a great company? So here's the reality with Aduro. It's one of the most interesting companies and sectors in the market today, in my opinion. But the problem, there's a couple problems, right? Like, we need to get actual client conversion. It's a small cap company. It's like, these are the companies that come with a lot more risk, but they're the companies that come with like way more upside. Like, when you're talking about like 10x returns, you're trying to get 1,000% gain. You will never get those kind of returns from a company like Google. Those days are over. If you're buying Apple and you're looking for 1,000% gainer, good fucking luck. Like, you're going to be waiting 50 years before you'll ever see numbers like that. But you always have to understand, like, if you have an appetite for risk and you like making a percentage of your portfolio like into higher risk investments, like, these are the kind of sectors you want to look at, like explosive growth, largely unrecognized, that are going to transform an entire industry. And Aduro has by far, like, as far as I can tell, the best technology. Like, they're not the first mover advantage, but they have the better technology, and at least it's patented. And I've seen a lot of videos on Facebook and TikTok recently of other people in other countries trying to make their own, and they almost kill themselves trying to make these machines. And they're like, guys, we can really convert plastic back to oil. And like, and they think it's like some new idea that never existed, and everyone's trying to bury it because no one's ever done any homework. It's incredible that this industry is evolving. I like Aduro, but like, you got to recognize, right? Like, there's still some risk. But if you want that potential upside, like, yeah, I like, that's why I'm holding Aduro. You don't, these are they're kind of, I don't even want to compare it to meme stocks, because it's not fair, because Aduro is an actual business. But like, you're buying I don't even want to call it a lottery ticket. It's like, because it's a real business, like, it has that potential, but like, you got to recognize it for what it is, right? When you're buying companies like this, like, you're looking to buy it to get that 10, 20x return, because that's what small caps do. You're taking on more risk at hopes that this turns into something much better in the future, right? It's the same thing with MindMed. It was the same thing with Canopy and all these companies, but those companies have evolved. MindMed still has potential. It's a neat company for sure. Biotech takes a long time. This company will not take a long time. I think you could see some real gains out of this potentially in the coming couple years. I would say 2 to 5 years max. Get some really big gains. I think BYD products are security risk, and that's why they're banned. Same with cell phone brand. Yeah, but you can buy Huawei phones. They're not banned, are they? I'm pretty sure they're not. The government just said don't buy them. I didn't even know how to spell Huawei correctly here. Oh my God. Yeah, Huawei. Phone. Banned. I love the spell correct. It's great. Huawei devices, including phones, not bans. I mean, is it banned? Jesus, come on. Do better, Google. Do better. Understand what I'm talking about here. Listen to the conversation. While Canadian government has banned Huawei from participating in the development of Canada 5G network, this does not mean that Huawei phones are banned in Canada. So they just don't want people using their network. That's understandable, I guess. But I don't know how you can stop somebody from buying an electric car. I mean, what if they manufactured them here? It'd be great. Either way. There's a company called Sila Waste Solutions that does something similar to Aduro. That's what I'm saying, though. Like, eventually the big companies are going to buy them out. Like, I can see Aduro being bought out by a waste management company for sure. I mean, even like Pure Cycle, I think, is largely owned by Procter & Gamble, because Procter & Gamble recognizes they shit out way too much plastic and they have no use for it. But now they do, or at least they're trying to figure out how they can utilize it. So fun to think about. But yeah, AQN to the moon after the last report. Oh God, you're bringing up nightmares, bro. AQN, there's a few stocks I got hit on, and one of them is in my bucket. I got out of it pretty early, thank God. But AQN, what a disaster. This is like a prime example of, just because a company's great doesn't mean it can't falter, right? All companies are risky at the end of the day. But look at this shit. This shit's wild, bro. Look at this. I mean, we had like a decade of just straight solid results. Stock goes up 500%, was paying like back in the day, like a 4 or 5% yield. It was one of the highest yielding utility stocks. And then shit hit the fan. Whew, baby, dropped 58% down still. Let's take a look at the earnings report. I never actually looked at it. I'd love to find out what's going on here. Yeah, what was the exact reason? There was some like really bad problem with their debts or something or whatever, the government, I think. Can't remember what was going on. Let's just take a quick look at their recent earnings, documents and filings, corporate information, stock information, I guess documents and filings. This is not going to just say quarterly reports, annual reports, quarterly reports. Let's take a look here. Q1 M&A. Let's just look at the financial statement. It'll be easier. Can you guys see that? Do I got it pulled up? No, it's on the other page. One sec. Let me share this. Yeah, this massive utility company. How are we doing? So total other revenues. What do we got for total revenues? 692 million. So revenue is recovering over last year. It'd be nice to look at a quarter-over-quarter revenue just to see what the prior 4 or 5 months look like. I should pull it up on Yahoo maybe. Everything looks to be growing. The regulated electricity distribution, their expenses, not so bad. Is that really all their expenses are? Is 500? Oh, sorry, 513. Yeah, that's a lot. In earnings up to 97. They're recovering some to 12 cents in EPS. What's their debt look like? I mean, they could be on a recovery. Are you into the recovery plays? I mean, it definitely could be on its way back. But I haven't done enough research. I'd have to listen to an earnings call and figure out what actually goes on with this company these days. But man, what a disaster this was once upon a time. What do the financials look like on a quarterly here? Yeah, it actually, I don't know if it's recovering. I mean, they were doing 666 million, 737 million back in the end of 2024. And today, I mean, they're really still only doing that 500 to 600. So they still haven't seen a whole lot of growth in revenue. But maybe because of interest rate drops and everything else that they're starting to recover and they're starting to retain some more earnings. Debt to assets still pretty high, but it's typical for utilities, but still a little higher than I like to see as a 50-50. 17 billion in assets and 10.7 in liabilities. Interesting company though, fun story. That one lost me a bit of money, I think. It's why I avoid investing in Canadian companies. I want to avoid investing in Canadian companies to get really good returns. And it's good for diversity. I mean, yeah, the S&P I think is obviously like the superior. It's why I own it. But I mean, like, what's the Canadian economy been paying out? I think I talked about this recently. Let's just take a quick look. VCE has offered some returns up to, where's my little chart? I got to pull it up on a fact sheet, or is it going to show me here? Show me the stupid graph. Let me just pull up the fact sheet. It'll be easier. Fact sheet me. Vanguard, what do we got for returns here? 9.18%. That's not bad. VCE representing the broader Canadian markets, very similar to VOO. It's market cap weighted, represents all of Canada, 9.18%. That's not bad. 5 years, it's up 17% and has actually been outperforming the S&P 500, or at least over the last year or two, I think, at least. Let's just take a look, actually. How's our charts look? You got to remember, too, VCE has been paying a much higher dividend. I think it yields like almost closer to 3%, so that doesn't really get included in these charts, but let's take a quick look. Over the last 5 years, the Canadian markets, or the U.S. markets over the last 5 years have been doing a bit better, but you still got to include that dividend, so an extra 2% over the 1% that VOO offers. So an extra 10% takes you up to 86. You've been very much in line. Like the Canadian and U.S. markets over the last 5 years have offered almost the same returns. They're not that far off. Opinions on Palantir, I think it's very expensive. It's a great company, but it's very, very expensive. I think it's a bubble personally, but time will tell. Is it smart to buy the underlying stock of an ETF and then just save? No, it's not. I.e. buy more Royal Bank, Scotia. So here's what I recommend. And I used to only buy individual stocks, but here's the problem with that. First of all, you could be very unlucky and you could be the guy that picks like the 5 worst stocks. And I've seen it happen. Not everybody can be like a financial education or Graham Stephan or have, even the luck that I've been able to like luck out on. But that's why I don't buy individual stocks anymore, because I recognize my own like stupidity. But what you got to understand is the reason you buy these ETFs, it's because it's a system. Because at the end of the day, when you're buying an individual stock, you cannot just buy it and forget about it. I think you just can't. I think it's stupid. I think it leads to underperformance. That's why most people fail at the market. They don't know when to buy. They don't know when to sell. And when you're buying these kind of companies, you cannot just hold on to them forever. You could have held on to ExxonMobil forever, and you would have, like, since the .com bubble, and you would have lost out on so much money. Like the S&P has so far outperformed companies like Exxon, which at the time was in the top 3 S&P 500 companies. The reality of buying these ETFs is you're investing into a non-emotional mathematical system that weights stocks based off their market cap value. So regardless of whether I like Tesla or I hate Tesla, I recognize that the market is fondling the shit out of it. And I would have been stupid in saying, don't buy Tesla, and then it goes up 100%. I still benefit from that 100% return regardless about how I feel of the stock. So let's say you think Apple is expensive, but then it stays expensive and it holds the whole indices up, right? Like, it's a very hard game to play. You're gambling. And essentially, when you're buying individual stocks, you're gambling on a future to some extent. Some gambles are safer, some are not. Tesla's a higher risk, so you get higher rates of return and higher risk investments like a Duro, right? That's a different form of gamble. But the reason that you buy these systems is because they just work. I don't care if you like Apple. Apple could underperform for the next 10 years and become like the bottom half of the S&P 500. But whatever is doing the best, whether it's genomics, and my bet is eventually healthcare will become one of the largest segments of the S&P 500, because I don't care about robotics and all this stuff as much as I realize that if you can extend life expectancy by another 20 years, there is nothing more valuable than that on the planet. So if we cure one of 3 diseases, whether it be cancer, heart disease, diabetes, there's a few of them. If we can just cure 3 things, life expectancy would go up by 20, 25 years. And that value of whoever invents that is going to, like, artificial organs or whatever, is going to be so far more wealthy, because eventually we will all need it. Eventually everyone will need it, right? But so you're going to get that exposure regardless to how you feel. Like, you don't have to find the companies. You don't have to worry about it. It will just get automatically figured out based off market performance. They are the most brilliant system ever created, and they are responsible for making more people rich in America than any other investment system ever made. Thanks you, and rest in peace, Jack Bogle. You've done a great thing for society, was by inventing this formula to investing. In fact, the same system he invented is for Vanguard, which is what we're looking at right here. It's a beautiful thing. So what you want to do is focus on these ETFs, in my opinion. And if I was a smarter investor when I was younger, use these to carry you. Focus on the ETFs. Like, at the end of the day, you always want investing to be very redundant and very simple. That's why I hate when I see somebody with 40 stocks in a portfolio. It's so dumb. It's so dumb. You really just want to pick a few ETFs that work out for your risk tolerance, and then take a bit of money with maybe 10% of your portfolio. If you're a little younger, you got a little bit more risk appetite, 20, 25%, sure, go for it. And then pick a handful of individual stocks you think you understand. It's really not hard. Like, it's just like, that's why I'm always talking about the same stocks. Like, it's not rocket science. I understand Google. I'm debating on search. Search isn't something an idiot needs to sit down and understand. Any normal person can have an argument about ChatGPT and Google search and the rest of Google's businesses. It's really not that hard. If you wanted to talk about curing cancer, that's a problem for me. You see why I'm not investing in cancer curing companies? I don't understand them. But how hard is it to wrap your head around Meta? I understand the balance sheet. It's very clean, very easy. The growth is there. I use Meta all the time. It's not rocket science. Video games, Take-Two Interactive. Is it really that hard? I pay for my phone bill. That's, TELUS. How does TELUS make money? Oh God, phone bill. I mean, it's not rocket science. So just pick a handful of companies you believe in. And if you want dividends, you can focus on those. If you want growth, you can do what I'm doing. Allied Properties. So I'm going to tell you something. I'm going to tell you something right now. I've come to a recent realization. It's not a fun one. I will never, ever again touch Canadian REITs. I have been having a lot of conversations with a lot of people that work in real estate. I've been horrified, disgusted. You got to ask yourself a question, right? So you got to ask yourself a question here. I'm going to pull something up. Okay, let me just find it real quick. Ask yourself this question. If I show you the Canadian real estate ETF, VRE, that represents all the Canadian real estate, and it's been around since 2012, and it is only up 25% since 2012. We went through the greatest growth period in Canadian real estate and US real estate history, and it all happened within a window of like 7 to 8 years. The window that you are looking at. Ask yourself a question. How, because the largest REITs in the country didn't go up in the greatest capital return in real estate history? You lived through that. You watched houses from 2016 on average, like depending on where, go from like 300,000 up to $800,000 in Ontario. I mean, I grew up in cottage country. I could have bought a home for 200 grand. That house is now selling for like $600,000. And that was a small house. A nice house could have cost you $380. And those houses are now selling for $800-900. So how the fuck did these companies not offer a higher rate of return? It doesn't make any sense. This like realization like blew my mind. I just, when people pointed this out to me and they were like, and you just go look at who's running these REITs and how they've been running these REITs. And then you go look at people that work in construction and how corrupt like the construction market's been in this country. I don't even like, it's crazy. Now you look at the new problem that's going on, which is like the condo market is getting like out of control. They keep saying that we have a housing crisis, but we have so much on the market right now. Condos, Toronto market. I'm sure you guys seen headlines. Look at this. Like even Gemini knows the Toronto condo market is currently experiencing a significant correction with both new and resale condos facing price declines and slowing sales. This is due to a combination of factors, including a glut of inventory, slowing demand, and a rise in interest rates. This is a buyer's market, and I would not be buying REITs. I would be buying a piece of real estate. That's what I would be doing if I had enough money. I'm like, I bought my condo probably at the wrong time, but I got a good deal on it. I don't care if it goes down in value because I've almost paid the mortgage off, probably have the mortgage paid off in the next 2 years. And I won't give a fuck. I don't care if it goes up or down. It's a home. It's not I consider it an asset, but I don't look at it as an investment. I just say, hey, if it goes up in value in the next 10 or 20 years, great. If it goes down in value 10 or 20 years, I don't care. It's just a cheap, affordable place for me to live that's very comfortable. So if I want investments though, hell yeah, I'm looking at the market every day and I'm looking at those deals and I'm negotiating because you have no bidding wars anymore, baby. So like if you were into real estate, open your wallet because fuck, this is the time, boys. This is where you get rich. I wish I was more into it, but it's very expensive and I'm definitely not. Also, what price do you plan to exit the TELUS trade? I already exited TELUS. I didn't even make or lose money on it. I bought it at $21.50, collected some fat dividend checks off of it, and then like somewhere around $20.50 or whatever happened, I sold it to buy the S&P because I was down way more on the S&P 500 than I think I was down at that time, 13. Either way, I was down more on the S&P, and I had $5,000 sitting in TELUS, and I'm like, I don't care about TELUS's dividend. Like where I just couldn't like help myself because I was pretty much flat on the position. So I was like, let's take a trade that hasn't done anything and put it into one that's gone down a lot. And sure enough, the S&P is going up like every day right now. It's great. I still might buy TELUS back. I don't know. I kind of flip-flop around. It wasn't a huge position by any means. I'm trying to keep concentrated on a few stocks. That's why I'm just like ungodly throwing money into a few things. Go all in on one REIT. Give the highest dividend. Great idea. Yeah, no, not at all. Like let's just take a look at something. Like the only one that I liked is Cap REIT. This is the only one that I have like any respect for to some extent. I mean, I was all over RioCan for the longest time, but like I've had an awakening. But yeah, Cap REIT's been trading in the toilet, but I still think it's probably one of the better REITs you can buy, and it has offered a really great rate of return. But find me another REIT that looks like this because they're far and few in between. Far and few in between. Do that. The real thing that bothers me too is like I look at a company like RioCan and I'm like, man, they own like all the property in Toronto. They have probably the biggest footprint just because they're outdoor shopping centers. Just tear those down and build condos or do whatever. There's so much opportunity with that real estate, but it's not the best stock to buy. Not the best stock to buy. Do that until I can afford a house, then rent that house for higher returns. Yeah, I think our long-term plan here is like we realize that once you get into the city and you get a comfortable place, you can never sell it. So like even like the wife's parents, and we've had this discussion too, not that like it's a serious discussion, it's just an idea, is that if we were to have kids and we needed more space, and this condo's like 1,300 square feet, it's too bad. Like it's enough space to have a kid. But I mean, if we needed more space and like her parents were getting older, like we would just switch houses because like this would be way less maintenance, way easier on them in retirement, or if they're getting older. And then we'd have more space for a kid. And like, you just can't sell this stuff. How do you sell it? I'm like, I get if you're wanting to trade up to something, but like, it's so, maybe I just went through too much of a stress headache trying to get a property in this fucking city. And it was just right when the market started to turn. There was no more bidding wars. It's not as like great as it is now, but we did get, like, I looked at 100 plus properties, fired one realtor. I mean, it was a lot of work to find this property, let alone that we were lucky enough to get it being the first property we liked. It's kind of wild. So yeah, the stress was just nerve wracking. So I don't want to sell it to try and trade up to a house or something. I'm very happy with it. So I figure if you just pay it off, like, what's the worst thing you do? If we need a bigger space, we could rent it out and then just go rent a house, like worst case scenario, right? Because I mean, this place would generate like $3,000 a month after expenses. You'd probably be bringing home still like, I mean, the total cost after mortgage is only like $1,200, I think. So, I mean, you'd easily be bringing home like what, $1,800. Like, you could easily probably cash flow 20 plus 25,000. Take that and probably just go rent a house and just use our investments to add a little bit more to that. Either way, we're in the market. All right. We have options. There's always options once you're in the market. What do you think about WCP? Let's take a look. Love and thanks for the great info analysis. Always appreciate it. Let's take a look at one more stock because you guys have been getting me rambling for far too long here. WCP. But yeah, please avoid the real estate market unless you really know what you're buying. Whitecap Resources. Whitecap Resources is a publicly traded oil company based in Alberta. I have to take a look, man. I'm not a big fan of oil because it's very cyclical and you can see it in the stock price, like, very cyclical industry to be in. So I don't like much exposure outside of what I get at a VDY when it comes to like Canadian Natural, mostly Enbridge. I like the pipelines. They don't go anywhere. They're much more stable, in my opinion. Well, you in Toronto, the highest real estate cost in Canada. Well, I don't know, maybe Vancouver, but at least one or two. Yeah, and like I said, if I had to do it over again, like I would have went to Alberta. We were this close to moving to Alberta. Very thankful we didn't because we're like 10 minutes away from the wife's parents. My parents are retired in cottage country, but it's still an hour. And I go see them once a week. It's like an hour drive. So we're very close to her work. She has to go to the office one day a week. It's like a 10-minute drive. Everything's close. We're a 20-minute drive to downtown if there's no traffic, which is really great. So we're in a nice central area. We can be in the airport in 15 minutes, even take an Uber, just take the 407, fast track to the airport. You're there in 15, 20 minutes. It's a very nice location. But yeah, we only just bought it because, again, if I was looking at myself and I didn't have my wife, I had moved. I would have just went and bought a property in probably Alberta. It'd be way easier. Because I mean, like, do you really want to I don't want to be 100% real estate. So I was like, I'm not going to take like all the money I've worked for to have no money in the market just to be in a place I'm living. But the wife and I, like I said, have this system right now where it's like, we want to be 50-50 at least. So we have 50%, well, basically 50-50 split between the assets in our property and the stock portfolios. So basically our mortgage, or not our mortgage, but the property value and our stock value are almost the same. So when our stock value drops, instead of paying off the mortgage, we focus on building the portfolio up. When the portfolio rallies aggressively, we go back to focusing on the mortgage and paying it down. And we're trying to keep our equity values equal until the mortgage is paid off. And then hopefully the stock portfolio like goes way beyond that. But that's kind of what we're doing right now, because it's just I don't know why we're doing it, but I just like doing it. It makes me feel better. It tells me when the market's undervalued. Thoughts on NTG. Okay, I can't keep doing this, guys. We can talk about stocks all damn night. I got to get out of here, but I do appreciate you all stopping in. Building a strong cash position. Tariff freeze coming to the end of July will correct the market again. Hopefully, I'd like to buy when it's down. But stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one.